Hi, I'm Anthony Smith, and welcome to this Wednesday edition of FreightWaves Now. We have an awesome lineup with Seth Holm giving us some market insight, but first, a word from our chief economist, Ibrahiim Bayaan. Ibrahiim, welcome back.
Hi, Anthony. How's everything?
Pretty good, pretty good. I know today you're going to talk to us about, I think, adjusted GDP versus traditional GDP.
Yes. So, for those of you that follow the kind of economic covers that we put out, one of the themes that I try to bring out is that looking at overall GDP isn't necessarily the best metric for gauging freight activity in the economy. So there are an awful lot of things that get captured in GDP that aren't necessarily relative to freight. So for example, like the US economy, about 2/3 of it is made up of service activity. So it's spending on healthcare, spending on financial services. Like this generates a lot of economic activity, but not necessarily a lot of freight activity. And so what I typically do with the GDP numbers when they come out is I'll take the data and I'll strip out all the things that I think are less relative to freight, and I focus just on the good side of the economy. And I think by doing that, you get a much better picture of what the freight economy is doing at any given point in time. So if you look at this chart here, I have a couple of different graphs. The green line here is traditional GDP. The white line is this goods adjusted GDP, which strips out the services and focuses on the things that generate freight. So a couple things to bring out. If you were to look at this period between late 2016 through the current period, in terms of total GDP, you're looking at a real acceleration in economic activity. Like growth was below 2% at the end of 2016, all the way up to 3.1% as of the most recent reading in the first quarter of 2019. But the goods economy really hasn't behaved that way. I mean, typically when you think about the goods economy and freight activity, the best period was the middle part of last year. And I think once you strip out these kind of components of GDP that aren't relative to freight, you start to see that a lot more clearly. So the white line here is goods adjusted GDP. You can see really at the end of 2017, you get a spike in terms of year-over-year growth on the good side of the economy all the way through the middle part of 2018 before things start to die down. And now you're at this period here where goods activity growth is a lot slower than overall economic activity, right? And so again, the idea is just to kind of focus on the components of GDP that are more relative to freight. It'll give you a much better understanding of how the freight economy is doing.
Exactly. And so with this GDP talk, GDP comes out, I believe, Friday. Is that right?
That's right. So the second quarter, first reading for second quarter GDP comes out Friday morning.
Any expectations for where that's going to head up?
Sure. I mean, I think the overall economy is probably going to slow down. I think this 3.1% growth that you saw in the first quarter of the year is probably going to settle around 2.6, 2.5%. On the good side of the economy, I think the growth is still going to be significantly slower. Like I think it's more reasonable to expect year-over-year growth of about 1.5%, maybe below that. There's still some goods data that has to come out between now and Friday that'll give me a better picture of where it'll settle. But I would expect that it's going to start to look very similar to what we saw in 2016. You can see the readings in 2016 were about 1.5%, slightly higher than 1.5% through most of this freight recession. I think the numbers when they come out on Friday are going to look very similar to that. Like you'll start to see things below 2%, around 1.5%, or possibly even lower than that.
Wow. All right. So, but definitely a more enhanced way of looking at the GDP, and something that we now have active in our Sonar platform.
Hi, this is Seth Holm. Today I'm going to be talking about an interesting topic for transportation investors. Is 2019 more like 2007 or 2001? The reason I ask is UBS recently put out a report taking a look at how transportation equities perform following the first rate cut in a Fed rate cutting cycle. The last time we had a rate cutting cycle was 2007 and 2001. Turning to 2001, after the first rate cut, turned out to be an amazing buying opportunity for transportation equities. Specifically, trucking stocks a few months after the first cut were up about 55%. Rails were up about 35%. And more importantly, both of these outperformed the S&P 500 by about 50% or more that year. Now turning to 2007 is a little bit of a different story. Not great, but not horrible. A few months after the first rate cut in 2007, rails did pretty well. They were up 3 or 4%. Trucking stocks, not so much. They were down 13%. Not great, but not terrible, at least in the first 6 months after the cut. They did end up going down in 2008 and 2009. Now, what this is telling me is because transportation stocks aren't down that much, or they could be up a lot following the first rate cut, That's because that they're leading indicators as stocks. So by the time the Fed is actually cutting interest rates, it's usually because the economy is deteriorating. So these transportation stocks may have already been beaten up. So to wrap things up, UBS concludes Fed rate cuts should be positive for transportation equities valuation support. However, they see that being overridden by fundamentals, which are still deteriorating, as we've seen here in the second quarter earnings reports, where a lot of companies have missed and or guided lower. Anyways, to summarize, it'll be interesting to watch. Here at FreightWaves, we'll be paying attention to this. And thank you guys for tuning in this week. Be sure to subscribe and hit like on YouTube, Instagram, and Twitter, and we will see you next week. Thank you very much.